Back to the broader market. Chris Conway from the Australian Stock Report. You saw him, glimpsed him earlier from Melbourne studios. Warm welcome into the program. Levels on markets. You are still sticking to what is, on reflection, a pretty bearish perspective. Let's talk this 47 to 4800 region. Likelihood of going back to those lows. How are you saying we might well just find that position yet again?
Good morning, Carson. Thanks for having me. Yes, I was on the show last week making a fairly bearish prediction of the market moving into 4,700. So far, that prediction has been made to look a little bit silly, but I'm sticking to my guns on this one. There's a number of factors that I think will take us lower. First of all, from a technical perspective, the overarching downtrend on the ASX 200 remains intact. We'd need to clear 5,300 and potentially 5,400 for that trend to shift. But look, one of the big interceding events fundamentally was the jobs numbers in the US on Friday night, which has pushed out the rate hike expectation. I think there's about a 10% chance now this month, 50% in December, and fully priced. It's not until the middle of next year. That's from US futures markets pricing that in. But the Fed has been pretty keen to say, especially after the last meeting, that the market shouldn't be getting too far ahead of itself, that an interest rate rise is still looming. And I think in the meeting minutes tonight, which will be released, they'll reiterate that December is still on the table. So, of course, once that rates lift-off comes, that's going to take some steam out of the market. As well as that, we've got US earnings season upon us. There's some data out that suggests aggregate earnings per share will be off north of 5%, which would be the worst quarterly result since the third quarter of 2009. And we've also had a couple of companies already report in the US citing China as a big worry for their individual earnings. So yeah, there's a lot of bearish evidence still out there. I don't think the evidence, although the immediate momentum in the market is bullish, I don't think there's enough bullish evidence to warrant shifting our bias from being bearish. So yeah, move back into 5,000 is certainly likely, and then I think we can still push into that 47, 4,800.
So you're adamant that the Fed does move, because if you look at the, as Albert Edwards has called it, the actual poverty of pricing power in the US. Well, even once you strip out food and energy from the CPI measures, you're looking at corporate revenues that remain very weak, particularly in the US. These are prices that have been bid up deliberately. Everyone would acknowledge that, deliberately, because the Fed's pushed people into that situation, but underlying it all, the revenue demand is anemic.
Yeah, look, exactly right. In terms of the impact on the Fed, though, I think they have to move, and they're going to have to move eventually, because they've been saying for so long that they will, and the consternation in markets will continue until we finally get this rates lift off. So, yeah, in terms of the numbers for companies and the revenue, it will have an impact, but I think the Fed, will still move. Possibly in December, if not March, early next year.
So you don't buy because the expression data dependent replaced in the last few months by market dependent, really sort of signaling or signifying that the Fed being led by markets, not data, in real economy terms. Even though no one will admit it. I would agree that the market's thrown a hissy fit every time that it's come close to the Fed having rates lift off, but they've continually said that an interest rate rise is looming because they've been talking about it for so long. Like I said, I think they almost have to do it. They will remain data dependent. I think they need to ignore for a large part what the market is saying, because the market's never going to like a rates lift off. It's just the timing of it. If they do it amid a really weak quarterly earnings season in the US, well, that would be a double negative, and that's probably one of the reasons, or one of the major reasons, why our market could push back into that 4,700 handle. Okay, let's talk China. Back online, extended holiday they return from today. Concerns there that if we're going to get more stimulus coming the way of that economy, the problem is that much of the credit already is bottled inside the financial sector. Very little of it actually flows on into the real economy. Do you find some sympathy with that?
Yeah, it's not. Honestly, it's not a question I've lent a lot of thought to. I mean, it's something that happens, with all the stimulus that's been going on around the globe. It does get tied up in the banks, and it doesn't filter out to the broader economy. And I think one of the more important things to consider with China stimulus is They mismanaged the market so badly when the market corrected 40%. I mean, that was just a disaster in terms of what Beijing did. I don't think there's a great deal of faith in China managing the economy. I think the economy is too large for the government to push around. So there's certainly still some worries there. So even if they do throw more money at it, as you rightly say, it doesn't filter out into the economy, and they haven't been effective in managing markets. So the question begs, would they be effective in managing their economy?
Okay, some thoughts as we know it around Woolworths. Let's move into that space, shall we, just briefly. What's on your radar? Because, of course, there is that October 20 deadline that's now we're inching ever close to on the Lowe's put option, which would be significant. What are you calling out there?
Well, interesting question, Carson. We've been short this stock in the past. I've been on this show talking about being short Woolworths. This would be, a significant event if Lowe's was to exercise their option. It would put Woolworths between a rock and a hard place. They'd have to stump up $1 billion for that 33% stake. Admittedly, they'd have 13 months to sort it out. But the share registry and the shareholders are extremely definitive on this one. They want Masters gone. I think the new CEO would be wise to listen to them. Sure, it's going to hand over $1 billion worth of revenue straight to their direct competitor in Bunnings and Wesfarmers. But I think this is a move that they have to make, and there's already some evidence that their sites are being shopped around. Colliers, the real estate agent, has shopped around some sites to Bunnings and I think some to IKEA as well. So we would no longer be short this stock. Like I said, this is a game-changing event. If they do dump Masters, one would expect to see a significant appreciation in the Woolworths share price because it would signal a move from the board that they're returning to their core focus, which is obviously the food and liquor.
When are they going to name a CEO?
Sorry?
When are they going to name the CEO?
Good question.
It's inordinate. Absolutely inordinate. Got to be one of the most incredible delays on a C-suite replacement being named that you can think of in recent times.
Maybe no one wants to take the job.
Yeah, well,
maybe it's all too hard.
Few would disagree with you on that one. Chris, thank you as always.
Thanks, Carson.
All right. Chris Conway, the Australian Stock Report there, live from our Melbourne studio.